let's get started. Let's get going. Kids make it simple, don't they? You know, Ryan just had a baby, everybody knows, about 11 months ago, 10 months ago. And, you know, they really have a way of putting it in the perspective. And as this cartoon says, please stop. It reminds me too much of the markets, the yo-yo. And that's just what we've been going through. And I'm not sure this is going to work, guys. So things to remember, to be a successful investor, make sure that your asset allocation matches your risk tolerance and return requirements, what you expect. We want to make sure that your expectations aren't unreasonable. It's important when it comes to investing that everybody have realistic expectations. You need a long-term time horizon, 3 to 5 years or longer whenever you're investing in stocks. For those of you that take distributions, you know that we take 2 years worth of your distributions, we carve them out, we feel that's important, so that when you see a small market correction like we're having now, it's okay because you know that we have 2 years before we have to really start thinking about the portfolio. We had the portfolio managed and we carved out 2 years of those distributions. Understand how your portfolio fits into your overall financial plan, which Marty, Ryan, and I, as 3 certified financial planners, Ryan is also a certified public accountant, we spend a lot of time making sure that, once again, you have the right plan for your goals and objectives. Be certain to have enough cash flow, what we call your emergency fund, 3 to 6 months of cash in case something bad happens, you lose your job or something. Become more aggressive when the market is down, like now. Become more conservative when the market is up. But long term, you're going to see with some of the slides that Marty and Ryan put together, you really can't ever time the market. No matter how many times you read that Forbes, Riches, you know, what I forget what they call it, there's never a market timer on that list. And if you were smart enough to be able to time the market, you would think you would definitely make that list. Continue to be systematic with investing cash. When you have volatility, don't let it get to you. Keep going. That's the beauty about discipline. Make sure that you don't stop doing what you're doing because it works long term. Now, we strongly recommend diversification. We feel it's good. And this chart shows, does it really pay off? And it's going to lead into another chart. As you can see, 2013, 2014, 2015, you can see the different returns for the different asset classes, starting with domestic large cap equity, small cap equity, international emerging market bonds, and commodities. And you see 2013 was really a phenomenal year. 2014 not as great. 2015 was one of those years where we call it kind of flat at the end of the year. Now, this beautiful color chart shows you, and these are all different asset classes. You know, if you come all the way over to the right, 2000 and 2015. It's a 15-year range here. The number one, the purple, is REITs. The second from last column, high yield bonds, small caps, emerging market equities, fixed income. A well-diversified portfolio is the gray where you see the line coming through. Large cap, developed market, international holdings, cash, and commodities. So you see all the colors, and you kind of go across for the different years. You never know which asset class is going to do better than other asset classes. This is why diversification is important, something that Marty, Ryan, and I pay attention to. As most of you know, we meet as an investment committee every week. We look at every holding that every client owns in our portfolio. And to remind you, 100% of my and my family's money is invested just like every client is. I'm in our growth strategy, which is our most aggressive strategy, and I wouldn't have it any other way. My money's invested just like yours is. And with the risk that we take, we look at these asset classes all the time, and it's so important that we really, truly kind of look ahead. We can't make any changes to the past, but looking ahead, we want to be, and we made some changes in the portfolio over the last several months, and we feel pretty good about where we're headed, which you'll see more as we get into the presentation. This is something that a lot of investors have to stop doing. As you can see, it's a cartoon in the top left. I've got a stock here that could really excel. And then the next guy says, really excel? Excel, sell, 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 sell. Then on the bottom, this is madness. I can't take it anymore. Goodbye. Goodbye. A buy. Buy, buy, buy. You can't follow the crowds. It's really not good. This is why. This goes back over the last 20 years, and it was quite a roller coaster ride, as we know investing can be, whether you're invested in stocks, bonds, commodities, like gold and so forth. Investing has its ups and downs, and as you can see, the first peak, March of 2000, PE ratio 27. The S&P was at 1527. Then it fell, bottomed out on October 9th, 2002, PE of 14.1, came all the way down to 777. Then it had a great run all the way to October 9th of 2007, PE ratio 15.7. The market closed at 1565, and then it dropped again. March of 2009 was the absolute bottom of that great recession. The S&P finished at 677 on that Monday morning. PE ratio at the time, 10.3. And here we are today. You know, this is through December 31st, 2015. The PE right now stands at about 16.1. The S&P at that time was 2,044. We know it's come off that high a little bit. But as you can see, investing, you'll have your ups and downs, and this is why we always profess that 3 to 5 or longer time horizon for any well-diversified portfolio. Anybody who needs money in the next year or two shouldn't have their money invested in the stock market unless they're willing to take chances, and there are chances that you'll be taking. Discipline, something that we profess, something that we follow. As you can see, all the way on the left, these are different asset classes. Starting out with REITs, this is average return from 1995 to 2014 over the last 20 years. By asset class, REITs, if you own REITs that time, 11.5%. The S&P, your average return was just about 10%. A 60-40 mix, 60% S&P, 40% bonds, 8.7. A 40-60, a little more conservative, 8.1. Bonds, 6.2, gold, 5.9, oil, 5.7, average returns. International, the EFI index, 5.4. Your home, on average, about 3.2 appreciation. All the way to the right, 2.4 was the average inflation over the last 20 years. And the gold bar is the average investor. Now, remember, go back to the S&P where your average return, if you're 100% invested in the stock market, is almost 10%. If you have a 60-40 portfolio, 8.7%. But this chart shows the average investor had an average annual return of 2.5%. Why? Because they didn't have the discipline. They buy and sell, whether it be in your 401k, investments that you have, maybe you're buying when you should be selling, selling when you should be buying, and so forth. And these are good statistics why the average investor really shouldn't try to time the market, because it doesn't work. Long term, staying the course is the best way to be invested. And we believe that we're in a secular bull market. And as you can see, this goes all the way back to the 1900s. No matter what happens around the world, the stock market has always survived. This goes all the way back to World War I, and you can kind of see the different events: World War II, Korean War, Vietnam War, stagflation, Black Monday, the end of the Cold War, the tech boom, which is more probably fresh on people's minds, the Great Recession of 2008, and the stock market, you know, there's ups and downs all the time. Right now, we think that this bull market will continue. We're just kind of taking a break right now, and it's a break that we've been looking for. We haven't had a 10% correction in the market since 2011, so this is a good slide. With that, I'm going to stop and hand the mic off to Ryan, who will go into the next section of our presentation.